Bill Lee, with the OECD shift yesterday to 3.3% global growth, are we heading for a Rosenberg recession globally where we've got dampened economic growth along with dampened inflation?
I think the OECD has recognized the reality that Europe is in the doldrums, and Europe's natural rate of growth is a lot slower. And also, according to David, our STAR model, I think one of the things the Fed has got to also recognize is productivity has not yet picked up yet. And as long as it doesn't pick up, our STAR is likely closer to zero than it is to half or 1% where they thought it was in the past. So there's a likelihood that policy mistakes are not going to be there because the structural nature of the economy is one of slow growth as far as the eye can see, except possibly here in the United States where a lot of the tax reforms, a lot of the Trump tax structural reforms and deregulation may have its impact in trying to boost U.S. productivity. And that's the hope and a prayer that we all have.
Bill, when you look at central banks around the world, who has it most tough? Is it the Fed with maybe even political interference? Is it ECB where you see these different countries and very little inflation, if not? Or is it the BOE?
I think the fact that expectations are adaptive means that the U.S. has got to reckon with the notion that we might be able to boost our long-term rate of growth. The ECB has got to recognize that the little bit of boost we got in the last year in European growth that had a two-handle really can't last. It has to go back to likely 1%. So those are the dilemmas that central banks have to deal with, the fact that expectations themselves are very sticky, and they tend to be adaptive and backward-looking.